Good morning, everyone. I'm Bill Danner, and Daniel Neesmith is here with me today. I'll introduce Daniel in a minute. The topic that we're going to be having today on our educational event. We welcome you who have signed up and are participating today. Just a couple of things to go over as far as announcements. We will be having our Bomb video produced today and do a drawing for our first quarter of this year on a referral program. I think we have about 14 folks that are in the drawing today who referred folks to us. We appreciate that. And the gift is a $100 Amazon gift card that we'll be giving away. And so look at the emails coming forth here shortly. We'll have that video out. Also, as far as things to look forward to, next week, Tuesday evening, we have an event, a client bring a friend double ticket night. It's a workshop on retirement planning at Natalia's. That one is full. We have 24 people or so already signed up for that. But on Thursday evening, the 8th, we will be at Props over in Warner Robins. So we encourage all of you, if you'd like to bring a friend and introduce them to us and have a good meal, and also some good information. Again, we'll be talking about the importance of refocusing and planning for retirement in light of all the things that's gone on in the last year or so. I'm sure there's a lot of people out there that have questions and concerns. So that's just coming Thursday next week, the 15th. And then on the 22nd, we'll have our annual shred event where you can bring all your stuff that you want to throw away. We'll have a shred truck there. Last year we invited and had a food truck there, a Mexican food truck. It was a great event, even in the rain. We had over 100 folks that showed up and participated in giving away their stuff and having a meal at the food truck. It's a Mexican food truck, Guitaras, I think it's called. In Mexican restaurant there in Macon. The food was excellent. So put that on the calendar for the 22nd. It's in the afternoon between 4 and 6. You can just bring whatever you want to throw away, and then we'll send you over to the food truck with a ticket in your hand for a meal. So look forward to bringing yourselves and your friends to that event. We look forward to seeing you there. Well, today, based on our last year's focus group we have with our clients, there are several subject matters that they wanted us to discuss in our educational events this year. And today's topic is risk management. And risk management is something I think is of concern for most people. There's risk, all kinds of risk to retirement, and not only our money that's in the market, but how we plan for our estate and basically health insurance, all kinds of things that we need to discuss. But today, Daniel's going to be talking about risk management, and we're going to have, so how do we define it? What risk really is? How do we find that risk? How do we manage that risk? Not only in our equity portfolios, but economic risks that may affect our retirement, etc. And the ways that you can actually deal with risk. He's going to cover those subject matters today. So again, thanks for participating. And Daniel, why don't you go ahead and take this ball and run with it. And anybody that has any questions, you can ask those questions in the chat box. I think Shane is also paying attention to the questions, and she'll be able to let Daniel know when we have questions to move forward. But everybody have a great day. Thanks for participating.
All right. So good morning, everyone. Today, we're going to be talking about specifically risk management, dealing with the stock market and portfolio management. Most importantly, having an understanding how we do it at our firm here. So we're going to dive right in. A big part of risk management is understanding how we define risk. And we're going to talk about the definition of it, and also how do we manage risk in a portfolio. This is important because we're in what I consider a heightened risk environment. We've seen over the last year how COVID dramatically impacted equity markets. And if you didn't have a plan in place, you probably were panicked. We always think you should have a plan, and people feel much more secure and at ease knowing that there's a plan for their portfolio and for their whole life, not just with the stock market. At the end, we're going to also talk about what economic risks the future may hold. So let's talk about how we define risk. First, let me back up. There's a lot of different types of risks. For example, people are living longer today than they have in the past. Inflation eats up our savings. Healthcare costs are going up twice the rate of inflation in the state of Georgia. Taxes are likely to go up, probably in the short term. And market risk is they are at heightened levels. So we're going to talk about today market risk in particular and some solutions for that. So how do we define risk? Well, Merriam-Webster Dictionary defines risk as the possibility of loss or injury, something that creates or suggests a hazard, and it goes into different details. Risk as far as an insurance contract. Number 4 is the chance that an investment such as stock or commodity will lose value, and something being at risk is in a state or condition marked by a high level of risk. Basically, risk means the possibility of loss, and that really applies to equities as well. What is market risk? So market risk is the possibility that an individual will experience losses due to factors that affect the overall performance of investments of the financial markets. I'll add to that volatility, or when something is unpredictable, they're a variation of risk. When you can't predict what something's going to do, it means that there's risk to it. So, for example, if you own a stock or a mutual fund, and we have a systemic crash like we did in February and March of last year, that means that it's unpredictable. No one saw that coming. So when you're in the market, you are taking on equity risk. We're going to talk about also in a minute how different people and different approaches to managing risk, but that's what market risk is specifically, is the possibility that you may lose money. So we want to try to figure out how to minimize that risk, right? So there's reasons for doing so. As people approach retirement, it's likely you will need your money for income. If you need money for income, you want to make sure that the money you're taking out is not as risky as the money that's your long-term growth money. We want you to take less risk with the money you're taking out for income, and that's so it can be predictable. Also, taking money out if you're down can dramatically impact your returns and erode your principal. The reason we're talking about this is because, number one, folks in our focus group last year wanted us to talk about how risk impacts them and how to manage risk in the market. But since then, we have seen last year the stock market fell incredibly fast, and the Dow fell 2,100 points in one day. The New York Stock Exchange circuit breaker tripped 3 times. That's something they put in place back after 2008, when trading was so volatile. They just weren't able to keep up with the trades, and people weren't getting their orders filled. So the circuit breaker tripped to slow down and eventually halt trading. And that's something that we saw happen on several different occasions last year. The other reason we're talking about this is we think everyone should have a plan to deal with risk in the market. Speed of market drops is something that continues to increase. What do I mean by speed of market drops? So it means how quickly the market drops. For example, if we look at how many trading days it's taken for a 30% market drop to occur, last year it only took 22 days for the market to drop 30%. The time previous to that, the shortest period of time it took was at the start of the Great Depression, February 6, 1934. 23 days from that date, it took 30%. It took 23 days for the market to drop 30%. Just one second. So I will get to your questions here in a minute. So the 22 days that elapsed for 30% market drop, no one wants to experience that. Step one is when you get to retirement, you want to make sure that you don't have all your money in the market if you're going to need to be taking income out, as I already mentioned. But also, you probably want to have a plan in place to deal with downside risk so you don't experience the full drop of the market. And there's several different ways to manage that risk, and that's an important component of what I'm going to be talking about today. The reason you want to manage downside risk also is because the amount of time it takes to make back up the losses. If you had $1 million and you lost 50%, you'd have $500,000 remaining. But if you made a 50% gain, you would only have $750,000. To make back the full $1 million, you'd have to have 100% return. So you want to manage downside risk. The math works against you when the market is down like that. If you have a dramatic loss, it takes twice as much of a return to get it back. I think and so does Warren Buffett, it's insane to have risk it's insane to risk what you have for something you don't need. I can't tell you how many times I've looked at someone's portfolio and they're taking on risks that are unnecessary. There's always going to be risk, but you want to have a plan with how to deal with it, and don't take more risk than you need to take to accomplish your goals. If you do take more risk than you need to, you're more likely to see failure. Here are the different ways you can manage risk. Unfortunately, a lot of people just try to avoid risk, and I like to use the word accept the risk. So here's an example. Someone has money and they don't want to have any exposure to the market, so they put it all in a savings account or at the bank that's FDIC insured. What they're choosing and trying to do is avoid market risk, and unfortunately they're accepting inflation risk, right? They're trading one risk for another. So a better way to do that is to reduce, manage, or transfer your risk. You can reduce risk by diversifying your portfolio, by not having all your money in the market. Also, you can have some of your money in principal protected investments that are likely to outperform CDs. You can manage risk. You can manage risk by diversifying, asset class diversification. You can try to buy undervalued securities. You can manage risk by hiring a professional portfolio manager that will manage the risk for you. Risk transfer means instead of you taking the risk, another institution takes the risk. So if you own an index annuity, the risk of your principal has been transferred to them. So we don't like risk avoidance because it's simply, bottom line is you're accepting risk if you're trying to avoid it. We think reduced transferring and managing the risk is much more appropriate, and you're going to see better results doing that. A lot of times people, when they get to retirement, they continue with the same plan that they had when they were working. They buy and hold risky portfolios or mutual funds, and unfortunately, they don't know about what's underneath the tip of the iceberg. As we all know, an iceberg, you only see the very tip of it, but underneath there's a lot larger portion of it. So we believe in the endowment model, which means asset class diversification. Don't put all your eggs in one basket, right? You don't just have to buy and hold stocks, bonds, and mutual funds. There's other asset classes where we can reduce risk by having different asset classes and having different strategies instead of simply having it all in the market. Guaranteed income strategies. For many people, they want a guaranteed income. So you can choose to transfer risk to, for example, to an insurance company for them to give you guaranteed income for the rest of your life. So that's a way to reduce risk as well. Pension style strategies, and in particular defensive strategies for turbulent markets, which is what we attempt to do in our equity portfolios. So step one is to figure out, what is your risk tolerance? Do you have a high tolerance for risk? Someone in their 20s, 30s, or 40s probably should have a high risk tolerance, and it should typically be dictated by how long you have before you need the money. Someone that's in their 20s, they shouldn't be afraid of market declines. It's likely decades from then, markets are going to be much, much higher than they are today. So step one is to figure out your risk tolerance. Where are you at? What type of strategy should you have? If you have a very low tolerance for risk, or even a medium tolerance, and you own all 100% equities with no downside risks protection strategies in place, you may be very disappointed when the market crashes like it did last year with a 30% drop. So you want to reduce downside risk if you have a low or medium risk tolerance and a short time horizon. So here's some methods that can be used to manage market risk. Step one is to diversify your portfolio. What does that mean? Own different asset classes. Don't just own tech stocks. Technology stocks have driven the markets in the last several years. We've seen that they have really elevated prices, and a lot of analysts, including myself, think that they're overpriced. And many times portfolios that I look at are highly concentrated in one sector, like technology. You want to think about owning different asset classes. You can own industrial stocks, materials, energy, consumer staples, healthcare, utilities, financials. Those are different asset classes, and you don't want to over-concentrate in any one. You can use something called a stop loss in your portfolio. This is not a method we typically employ because you can have an issue with being what's called whipsawed. What a stop loss does is if you can put a price and say, if my stock drops to this price, I want to trigger a market trade to try to get out. So you can say, I don't want to lose more than 10% on this position. And it would automatically trigger a market trade at the current market price. It would trigger a trade when it dropped to that level. The problem with doing that is that sometimes the market jumps right back up and you've locked in those losses. So we typically don't use stop loss strategies for that reason. Many times they'll jump right back up and then you sold out when it was at the bottom. Hedging options. You can use options such as puts. Put options can be used to hedge against your portfolio. If you buy a put and the market goes down in price, the value of that put can come up. And those can be utilized. It's not something we typically do. We lean more into diversifying your portfolio and investing in dividend-paying stocks. Companies that pay out their earnings instead of reinvesting for growth typically are less volatile. It's another term for it is value investing. Companies that are sending out shareholder value in the forms of dividends or cash payments. Dividend-paying stocks are going to give you less downside risk in general than owning growth stocks. Blue chip stocks are companies that have paid dividends for 25 years, that have a very long track record of raising dividends, of consistently paying them, and that's why they're called blue chip stocks. We like that. I like that approach to identifying value and owning quality stocks, and in particular buying them when they're on sale. Another method to use to manage market risk is sector rotation. This is when you own different sectors of the market at different times in the market cycle. So if we're in the beginning of a bull market, for example, there's sectors that typically do better, like industrials, materials, and energy, and there's sectors that don't do as well. Financials tend to do worse at that period of time. So that's a couple of different approaches to managing market risk. And again, we believe in diversifying, in investing in blue chip stocks, dividend paying stocks, and to some degree sector rotation. So every portfolio that we construct, we're looking at different metrics to help manage the market risk. All investments begin with the following. We like to use undervalued stocks. When a dividend for a blue chip stock is high, typically it means the price is low. You can look at their historical dividend yield to determine if it's under or overvalued. And when we buy stocks, when we're starting a portfolio, we want to find them in the undervalued category with an S&P ranking of an A- or better, a designation, a G designation for long-term dividend growth. We want PE ratios, if possible, of 15 or less. And for dividend-paying stocks, which is what we're talking about. We want to see their payout ratio at 50% or less. What that means is, of their earnings, are they paying out more than 50% of their earnings to cover that dividend? Long-term debt to equity of 50% or less. You don't want to own stocks if you're a lower or moderate risk person that has a lot of debt. So if you can find a debt to equity ratio of 50% or less, or 75% for utilities. So that's what we start with when we start screening for what is owned in our portfolio. Second, we also look at return on invested capital. This means that they are turning a profit. There's a difference in investing and speculating. So if you own a stock, for example, Tesla, there was a time last year where their PE ratio, price to earnings, where people were paying 1,200 times for every dollar of earning to buy that stock. That's speculation. We like to buy stocks that have a profit, that have a return on invested capital, particularly 10% or higher or greater. Free cash flow yield of 5% or greater, that's what they're earning on their money that they're investing. And a price to value ratio between 0 and 1.6. So that's a very important, those are the criteria we use when we start our security selection. If you buy it right and you buy undervalued, you've already reduced your risk. It makes sense, right? If you buy something that's highly overpriced and then things go bad, you've already overpaid, so you've got much further to fall. I know people who bought houses in 2007, and it could be argued that we're in the same situation now, where home prices are very high. And then what happened in 2008? Well, the real estate market busted, and we saw property values drop as much as 50%. So you want to make sure you're buying right. And that's a very important component of reducing your risk, is buying it right. And we don't trade out of our blue chip stocks until they get into the overvalued category. So if I owned Pepsi, for example, and it was doing good and growing, then all of a sudden its dividend yield, current dividend yield, was low and its price was high, it would become overvalued. And that would mean I would trade that out, and maybe we would buy Coca-Cola or something in a similar sector. And that keeps your risk lower. You don't want to continue to hold overvalued securities if you can help it. So we think that buying blue chip stocks with a long track record of delivering value, coupled with ETFs, exchange traded funds, they can give you a better risk adjusted return over a full market cycle. So one component of our portfolio, the most important, is the individual blue chip stocks that pay dividends. Another is the strategic portion of our portfolio. So we construct the portfolio, I do every month, and we've got different categories on here. Select blue chip stocks represent the majority of most clients' portfolio if you're a growth or moderate risk investor. Sometimes if you're a very low risk investor, we would allocate more to the strategic ETFs. Now, the purpose of strategic ETFs, and just to describe what an ETF is exchange traded fund. They own lots of different stocks all in one fund. They're like mutual funds in the sense that they own a lot of different securities instead of just one. But they differ from mutual funds in the sense that you can sell them at any time during the day. You don't have to wait to the close of business to sell an ETF. And generally the fees are lower, much lower inside of an ETF. So the reason we own ETFs is to help reduce risk. We can go 100% into cash or treasuries in these ETFs. We will own 10 of them at any given time for the purpose of reducing risk in a portfolio. So it's a quantitative approach that follows patterns in the market, and it's based on their return potential over the next 25 days. So we want to make sure that we have a downside volatility target, and the 10 that we select are meant to reduce your risk in the portfolio, and they're traded at least once every 25 days. So inside of your, when you get a trade confirmation from us, it's probably for an ETF trade that we made. We trade these more frequently than the blue chip stocks because the purpose is to own the 10 that give you the best risk return ratio over the next 25 days. So we select 10 ranked ETFs from a universe of over 100 based on their return potential. So right now, the 10 that we own, there's a lot more opportunities outside of the U.S. right now. For example, we own some equities in South Korea and Asia. Those valuations are much lower over there, so it gives a good risk return ratio. We're looking for a good risk adjusted return. But those 10 ETFs can be 100% defensive, and they were last year during the months of February through really the end of April. A lot lower risk, and as environment changes, as the market and the economic indicators change, we will get more defensive because we want to make sure that we have downside risk protection, and we utilize these in order to do so. If you own a moderate risk portfolio, you'll have 35% of your portfolio in these types of funds, ETFs. So they're intended to provide risk reduction during volatile and bear markets. All right, so let's just see if we have any questions here. Let me jump over here to the chat. We do have a question. What are some good websites to find relevant risks that are trustworthy? So there's no one good website. I look at a lot of different ones. Seeking Alpha is one. We use Zacks Investment Research as well. You'd have to have an account to be able to use those. There's the Wall Street Journal. They have good information in that. But as far as a website goes, Seeking Alpha is one, and like I mentioned, Zacks Investment Research. There's a couple for you. So let's talk about some possible challenges and headwinds to the economy. This is not an exhaustive list you see on the screen, but over the next decade, here are some different things that are likely to happen. You shouldn't be surprised by any of them. The U.S. federal debt will rise. That's not a shock, is it? We're talking about a $2 to $3 trillion infrastructure overhaul right now in the next couple of years, and that's what the approach is. So the federal debt will rise. I will add to that, taxes are likely to go up. You can't have the type of deficit spending indefinitely like we have. So we always think it's important to plan for the future with taxes. You want to have taxes as tax plan as part of your financial plan in order to make sure you can minimize that risk. Healthcare will become more and more expensive. No shock there. So that's another headwind. The economy will boom then bust. Now, there's a couple of reasons for that. One is the Federal Reserve is so accommodating to markets and favor stock markets over maybe your Main Street people, right? They're going to favor the stock market over and Wall Street over Main Street workers. That's kind of their job. But the economy will boom then bust. I believe the real driver of that is easy money, low interest credit, and that causes bubbles in the economy. Whenever you give people money for cheap or free, and then it gets invested in the market, that boosts up equity prices, boosts up real estate. It entices people into the market who otherwise wouldn't be in there. If you can borrow money at near zero, people will invest that typically wouldn't. And you also can borrow money and invest on margin. So the boom bust cycle is not going to go away. That's why it's so important to have downside risk management as a component of your portfolio. Climate change could threaten our financial system, they say. That's certainly a long-term possibility. There's more and more talk about that, and it's likely there will be policy action in the U.S. regardless of our stance on it. The value of the dollar will dip and swell. It has been somewhat volatile, but still the world's considered world reserve currency. There has been a shift away from the dollar over the last 25 years. Fewer and fewer international currency exchanges are done in dollars. We're down we're below 50% of global oil contracts that are priced in dollars. So we're seeing that. So those are some of the major challenges to the economy. In the short term, though, I think tax policy will be a major player along with the federal debt. As long as our GDP continues to grow, and as it has been, in theory, we can sustain these debt levels. But at some point in the future, the U.S. debt ratio will be too risky for investors or for China or Japan to continue to buy our treasuries, and they will demand some type of change and to reduce the debt level. The number one holder of U.S. debt is our individual investors. There's a fallacy that China owns all of our debt. No, the American public owns more of the debt than China does. They own it through funds. They own it through bonds, treasury bonds. And so China doesn't hold all of our debt. But that's still a significant challenge that we have. All right, so does anyone else have any other questions before we wrap up? So what we did was we defined what risk is, we defined how we manage it, and some possible challenges to the economy that will probably create volatility in markets. So if I don't have any other questions, that is today's presentation. Anyone that sees this, and feel free to, there's going to be a link sent out. Please share this with your friends, because more than likely they do not have any type of strategy in place to handle downside market risk. So feel free to share the video link with your friends. And here's the phone number you can call to schedule a consultation or give to anyone that may need to do so. All right. Well, until next time, everyone take care and have a great rest of your day. Bye-bye.